if you question whether some business or industry is in your circle of competence, the answer is it is not in your circle of competence. So, if you look at a business and or a company uh, and it's obvious to you, how they make money, how the business works, what are the factors that affect it the most, and what are the leverage points and all of that. That's really where circle of competence comes in. And so most of us start out with a very narrow circle of competence because, obviously we don't come on earth knowing too many things. And by osmosis, in general, it's going to expand over time. But actually, the size of the circle is quite irrelevant. So one could have a really tiny circle of competence and do really well. The important thing is to stay dead center, stay well within the circle, and not wander to the edges or beyond the edges. Those are fatal mistakes. So I think that one needs to. It's a kind of exercise in humility and an exercise in candor with yourself. That if you're looking at something, I mean, in my investing career, when I look back, I have had my head handed to me multiple times, investing in leveraged financial institutions, banks, lenders, and so on. And what I learned after a lot of pretty heavy losses over the years is I'm just never going there again. So if you look at any typical bank, for example, it's a pretty straightforward business. It's not a complicated business. But the thing is that the loan book is a black box. You don't know what's in the loan book. You don't know exactly what underwriting criteria was used to make a particular loan, and whether a lender has great lending discipline or not. It can take 5 or 10 years after they've lost discipline for it to manifest itself in their numbers and so on. So basically, the nature of those black boxes makes it difficult for someone like me, and it took me a while to understand that. Someone like Warren Buffett has done exceptionally well investing in lenders. I don't think he's ever lost money investing in a bank. He's never made a mistake, but he's lost a lot of money investing in retailers. So when Buffett invests in retailers, he had a pretty high error rate, but when he invests in banks, he has a very low error rate. In my case, I hate retail, so I try to avoid it to to start with because I think it's just a very difficult um, area to do well in. And anytime I see either a bank or a lending institution of any kind, I just say, okay, it's like biotech. I don't understand anything about biotech. So I'm not going to make investments in biotech. I don't like U.S. healthcare because they have a lot of non-market driven forces that drive outcomes. I also don't like kind of defense contractors because it's so, you got one customer. There's a lot of politics and whatever, and kind of macro factors that affect that. So there's entire kind of industry codes or industries that I'm not interested in for a variety of reasons. So there's two approaches you could take. One approach is to not bother with expanding the circle. So if you have multifamily real estate, for example, that's a large enough area. uh, you know uh, Charlie Munger had a friend. He passed away a couple of years back, John Arriega. He was a multi-billionaire, and his daughter is actually married to Mark Andreessen. So they're multi-billionaire to the power of multi-billionaire. So but John Arriega only invested in uh, real estate within 2 miles of the Stanford campus in his whole life. He never invested in anything else. And basically, it was either housing or, commercial. He might even do shopping malls, but it had to be in that geography. And in general, I think in real estate, around college towns, especially residential around college towns, student housing. That's how Sam Zell started, and he did really well. So, and Stanford is a great. I mean, that area is awesome. You got so much venture capital and wealth and growth and all of that. And what he did was that, whenever things got very euphoric, uh, he got rid of the entire portfolio. I mean, when things got, the cap rates went to 3% or 4% or something. He was just, and his occupancy is 100% and rents are sky high and all that. He unloaded everything. And when things got depressed, he bought them back, and he used leverage, but not that much. So he always kept his leverage levels pretty low, and he did extremely well with that approach over a long period. So he didn't go into downtown San Francisco. He didn't go, you know, across the bay. I mean, he didn't go into other industries. I think if he was the kind of guy, if someone talked to him about some tech business or whatever else, he would listen, but it would have no impact on him from an investing point of view. And so I think that that's one approach. The Arriaga approach is a great approach, which is he found. I mean, and he was the kind of guy that if you walk down some street in Palo Alto, he could pretty much look at any building and tell you what its situation was, when it was built, and square footage and rents and all those kinds of things. I mean, he knew it cold. And if a deal came to him, it would take him 2 minutes to know whether it was a good deal or not, because he knew all those properties so well. Just so all of those things gave him a huge advantage. I think that if you were going to kind of branch out, if you will, uh, the best way to do it is to start really small. So make a small bet, and obviously talk to people and experts and so on. But you could make a small bet and use the time after you made the bet to get your arms around it, and then you can compare what you were doing to the one that you went into and say, okay, which one is better. Multifamily, you understand has certain dynamics, and if you go into retail or something else, you understand that dynamic, and you can kind of figure out what's going on. Um, so I think with retail, like I said, I think location is huge. Local knowledge is huge, and really depth of expertise is huge. Um, so I would kind of tread carefully. But you could experiment on a small scale where things don't work. It doesn't make much difference. If things do work, then you can gradually increase those bets. The good thing with public companies is that you have large, long histories that you can look at. And Buffett says industries with rapid change are the enemy of the investor. So you ideally want to really invest in businesses that are very static. They don't change. I mean, humans haven't changed the way we deal with our dead in thousands of years. It's just it's very static. We're not going to come up with some new. When your favorite uncle dies, you're not going to experiment with some new whiz bang way to take care of his remains. You're going to try to keep it done in a very respectful, traditional way that he or he would have wanted. And um, and you also don't take the low bid. You don't call like 10 places and take the lowest bid, or buy the cheapest coffin or whatever else. So it's actually a business that has very favorable economics, because typically margins are good. We don't get a lot of Mark Zuckerberg saying, I want to, like, you know own the funeral business. you know Not too many 22-year-olds are saying, I want to really revolutionize this industry or anything like that. So it's protected. A lot of people don't want to go into it. It's kind of morbid. And and there's it's tradition bound. So if your family's been using a particular funeral home, you're likely to keep using them, and so on. So I think the funeral business is one of the easier businesses to figure out, because it's relatively straightforward. Um, even things like oil shipping, etc. I think when you study it, it's I think to get your arms around it, um, isn't isn't that complicated. Again, like I said, these things don't change when oil is produced in Saudi Arabia and needs to needs to go to China or something. There's only a certain way you can get it there. You know, there's really no other options.